Welcome to another video in fraud examination and forensic accounting. In this chapter, we're going to be looking at financial statement fraud. To start with, what is financial statement fraud? It's intentional misstatements or omissions of amounts or disclosures of financial statements to deceive financial statement users, particularly investors and creditors. So it goes against the very purpose of producing these financial statements. My intention is to deceive those financial statement users. It also includes misstatements arising from misappropriation of assets. So assets, the classification of assets, will go over each of those and how, if they're misappropriated, what the consequence can be on your financial statements. So the question is, how does financial statement fraud come about? To start with, there is immense pressure on upper management to meet earnings expectations. Unfortunately, we have a short-term view of a company's life instead of taking the long-term view that the company is going to be there for a long time. The pressure is increasingly on a quarterly basis, on a monthly basis. Have they performed the way we expected them to perform? And sometimes the expectations are rather unreasonable. So this puts immense pressures on upper management to probably think about committing fraud in financial statements. And then we have accounting itself is a little subjective in terms of how the rules are interpreted and how we actually apply those rules to accounting. And that kind of opens the door for fraud in financial statements. Typically, we have three questions that we need to ask ourselves when we're looking at financial statement fraud. Who commits the fraud? Why do they do this? And how do they do it? So the who, why, how, those questions we're going to ask over here for financial statements. We've already talked about upper management, and we'll see who else commits fraud. So we have three groups of people who commit fraud. The first is senior management, the upper management. We do have middle and lower level employees also committing financial statement fraud. They probably, in most cases, when we find this kind of fraud, it's being done at the direction of senior management. And then you have organized criminals. Our focus is going to be on senior management. Why do they do it? We've already talked about this, but let's look at it again. Senior managers and business owners have many reasons to cook the books. Cook the books basically means to produce fraudulent financial statements. If their business is not doing well, they don't want anyone to know about it. So they want to conceal the true business performance. Ego, to preserve personal status, to preserve control. I don't want to lose my job, and my job is dependent on how the company performs. And if my financial compensation is tied to the company's performance, my personal income, my wealth is tied to the company's performance, again, it's supposed to be an incentive for me to make sure my company does well, but I could actually falsify financial statements so that I get compensated the way I hoped I was going to get compensated. How do they do this? Again, you have three ways in which it can be done. One is playing the accounting system, the other is beating the accounting system, and the third is going outside the accounting system. So what do these words mean? Playing, beating, going outside. Playing the accounting system means that someone is using the accounting rules to their advantage in producing financial statements that will give the desired results. Take depreciation as an example. Depreciation is an adjusting entry. There are two estimates that we make before we can calculate depreciation: the estimated life of the asset and the estimated scrap value. If I play around with those two numbers, I could change how much depreciation expense is going to be charged to the company's income statement, and therefore it will change my performance. Bad debt expense is another example. There are several such examples that you will see as you go along, where someone could play the accounting system. Revenue recognition, where they're using the completed contract method or the percentage of completion method, that gives you different revenue numbers. So what we're looking at over here is, when you're playing the accounting system, eventually it's going to catch up with you. But in the interim, in the short term, I may come out ahead. Beating the accounting system is someone falsifying things by way of false invoices. I say I have revenues that never happened. That's fictitious revenues. Uh, so that's completely lying about the system now, because it's never going to correct itself. Going outside the system is I come up with financial statements that are completely fake. There are no source documents. There's nothing to back it. I just produce financial statements. And what you'd see is typically it starts with someone playing the accounting system, and the more they can get away with it, greed sets in, and then they start beating the system, and then at some point they're going to go outside the system. Uh, all of these take effort, and it's a matter of how desperate people get eventually that you will see these crimes get worse and worse. How does this play out in public companies versus private companies? Which one do you think it's going to be easier for financial statement fraud to happen? Public companies have lots and lots of rules and regulations they have to follow. They have to have internal controls in place. They have those outside auditors coming and checking. So typically what you would see is, because of a stronger anti-fraud environment, public companies, if someone has to do a crime over there, it's usually timing difference, the type of fraud that they commit. So it's not really easy to commit this kind of fraud in a public company, the financial statement fraud. On an average, you will see that if it happens, there are larger fraud teams that are used to circumvent the controls, basically saying that it can't be a one-man show. It's very rarely one person doing it and no one else knew about it. It's a whole team of people doing it together. And when those frauds happen in public companies, the dollar amounts are staggering. They're way larger than in private companies. And also what you will see is the larger size of public company financial reporting fraud cases that we hear of, it may make them more likely to be detected by formal means rather than by accident, which basically is saying that it's not going to be a tip that's going to for you to know that something is happening. There are formal mechanisms within which you can find this. Basically saying it's a lot more structured in large companies versus in smaller companies. But fraud happens both in public and in private companies. All the reasons we mentioned, who, what, how, all of those happen, why, it happens both in public and private. Okay, so who are the users of our financial statements? And now obviously we're concerned of them becoming targets. You have potential, the current and potential investors. You have the lending organizations. You have vendors and customers. So all of these people rely on financial statements. And if those financial statements are fraudulent in any way, shape, or form, they are making decisions based on fraudulent information. And obviously those decisions are not going to be good, certainly not good for them. So is there a cost associated to this fraud? Obviously, this fraud, I'm talking of the impact of the cost, the impact of the fraud. Obviously, the impact is pretty severe. To start with, it undermines the reliability, the quality, the transparency, integrity, etc. of financial reporting process. So everything that we as accountants do and we take pride in, that goes on by the wayside if those financial statements, people can't rely on it. It diminishes the confidence of capital markets and the reliability of financial information. So capital markets in this country are free and fair, largely because those financial statements can be relied on, and anyone, literally anyone in this country or somewhere else, can invest their money knowing that those financial statements are basically something that they can make decisions based off. But if those financial statements are in doubt, then the capital market is going to be a little leery of giving us money. So the markets are going to become less efficient. This has larger impact because remember, if large companies do not get the monies they need to expand their business, it's going to affect the nation's growth. Growth, prosperity, employment, all of those things get affected. Lawyers are the only ones who come out ahead, I think, but someone has to pay the price. And when companies are involved in litigation, it's the shareholders that suffer and employees also suffer in the process. It destroys careers of individuals involved in the financial statement fraud. And in many cases, it could be everyone is painted with the same brush. So it could be way beyond the people who are committing the fraud. In several cases, we have bankruptcies that basically have, again, larger impact on the economy and the community, etc. As an example, when Enron went under, Enron was one of those companies that was cooking their books, and it was staggering in terms of the dollar amount of what they were, the fraud that they committed. And when it finally came to light what they had done, and the company filed for bankruptcy, obviously all their employees lost their jobs. Most of their employees had been encouraged by the CEO and others, top management, to invest their pension money in the company stock, so their pensions were all gone. And Enron used to give a lot of money to charity, lots and lots of money. In the Houston area, they were the single largest donor to almost all not-for-profit organizations. There were several synagogues who probably 95% of their revenues, their donation revenues were coming from Enron. And overnight, all of those not-for-profits suffered. So the economic impact of those losses are far-reaching. It goes way beyond the company itself. And none of us like regulation. We like to have a free market. But anytime you have bad actors, you're inviting regulation, which is what happened with the Sarbanes-Oxley Act, PCOB, etc. All of those things are a result of bad behavior by a few companies. It causes devastation in the normal operations and performance of alleged companies. Obviously, they're going to be severely crippled. No one will want to do business with them. Jeopardizes the integrity and objectivity of the auditing profession. Again, using Enron as an example, their auditor was Arthur Andersen. The Houston office, the auditors in the Houston office certainly deserve to lose their job, their license, etc. But all of Enron went under. Enron was a very, Arthur Andersen, all of Arthur Andersen went under. Arthur Andersen was a very large corporation, a public accounting firm. They had offices around the world. They had offices here in Baltimore, and the Baltimore office shut down. Everyone lost their job because of what happened in the Houston office. It's not fair, but the whole issue is the accounting profession as a whole suffered, not just all the auditors within Arthur Andersen. So this is pretty severe. It erodes public confidence in the entire accounting and auditing profession. So all the way around, there are way more losers than you can imagine when there's financial statement fraud. And financial audits obviously are going to, no one is going to believe that they are really, the audits are doing what they're supposed to do. So what are some of the fraudulent schemes that are used? There are 5 categories we're going to be looking at: fictitious revenues, timing differences, concealed liabilities and expenses, improper disclosures, and improper asset valuation. So let's start with revenue recognition. We know that revenue should be recognized when it is realized or realizable, and it is earned. So basically what we're looking at over here is the earnings process should be complete for us to say that we're going to recognize revenues. So all of the following criteria must be met. There's pervasive evidence that an arrangement exists. Delivery or has occurred or services have been rendered. So there is an arrangement. I have done my part, and the seller's price to the buyer is fixed, or it's fairly, there is no doubt about the amount of money I'm going to collect. And I'm reasonably assured that I can collect the money. So this is something we know about revenue recognition. So how can someone come up with fictitious revenues? Oh, well, quite easily. You record sales when goods or services were not delivered at all, okay? Artificially inflate or alter invoices to legitimate customers. So you're faking those revenues. You're saying that instead of $1 million in revenues, you have $1.2 million in revenue. You inflated by 200,000. There is a customer, there was a sale, but the numbers have all been altered. A quick example is sales with conditions. This is when you have a sale with the right to return. You're not supposed to recognize your sale until those conditions have been met. What's the condition? The condition is right to return. So once that period passes where the customer can no longer return the goods to me, only at that point of time I'm going to recognize it as revenues, not until then. If I do it before that, it's a fictitious revenue. So to give you an example, in the fall season, at this point of time, if you go to stores like Home Depot and Lowe's, the big items, big ticket items that they're selling, you will see it outside their stores are going to be these snow blowers because it's anticipation of the winter season. Manufacturers sell those items to these stores, to these retailers, and the typical terms are sales with the right to return. That is, if you cannot sell these items by October, November, whatever that date may be, they can return it for full credit. So those manufacturers should not recognize it as revenues until that time period has passed, October or November. Only then they should say it's a revenue. So there are many such industries where these kind of conditions are placed, and it's a very normal process. There's nothing wrong with that kind of business arrangement. What's wrong is if you recognize revenues before you actually have it. Timing differences. Recording them in the improper period. We've talked about recognizing revenues in, let's say, in December when it should actually be recognized in January in the next year, or recognizing an expense in the future when it should be recognized right now. So you're shifting your revenues and expenses between periods. And why are we doing this? To increase or decrease earnings as desired. Why would I want to decrease earnings? It's not uncommon when in the public arena, if my earnings are way too good, I decrease it and I move some of it to the future. I'm creating these reserves and moving them to the future. So in the future, if something happens, I still have this buffer. So those are called earnings management. It's not uncommon where companies would do that. So they do that by way of shifting the revenues or the expenses. Okay, premature revenue recognition. In long-term contracts, we've seen those revenue recognition, how that can move around. And channel stuffing, again, channel stuffing is the example that I gave you about Home Depot and Lowe's. If the manufacturer tells Lowe's, let's say, for example, let's just take one store in Lowe's, that each year they sell about 500 snow blowers. And the manufacturer tells Lowe's, I'll give you 1,000 snow blowers. Don't worry about it because you know you can return all of it. And I go ahead and recognize, the manufacturer recognizes the revenue for the 1,000 snow blowers, knowing fully well that that particular Lowe's store can sell only 500. That's historically been the number that they sell, about 500. That's called channel stuffing. So you basically just stuff it, tell the retailer, take it, and I'll take it back later on. Okay, and that's obviously not allowed. Those forms of trying to boost your revenues are not allowed. Okay. Concealed liabilities and expenses. This has a significant impact on reported earnings. And how does this happen? Okay, it happens by way of just completely omitting the liability or expense. So at the end of the period, I have an adjusting entry I need to make. Salaries expense debit, salaries payable credit. By completely omitting that entry, I've omitted the recognition of an expense, which would lower my net income, and I've omitted the recognition of a liability in my books. And why is that such a big deal? Salaries payable is a current liability. It's going to affect my current ratio. So companies do this for obvious reasons. They want to manage some numbers. Capitalizing expenses. Expenses have to be, obviously, you have numbers that have to be expensed. You shouldn't capitalize it. When you buy a long-term asset, you capitalize it, and then you subsequently expense it by way of depreciation expense. But if you paid for repairs and you capitalized it when it is not a capital expenditure, what you've done is effectively moved the number from the income statement, what should be an expense, you moved it into the balance sheet as an asset. So you made your income statement look good, and you're also making your balance sheet look good in the process. And failure to disclose warranty costs, liabilities, these are all year-end adjusting entries. You're not recognizing this. And what's the significance of something like warranty costs and liabilities? These are basically representing future expenses. You made a sale today, that's good for you. But if there's a warranty with it, there's a likelihood that in the future, you may have to pay out for repairs, expenses, replacements, whatever the case may be. And if you don't disclose that, you're obviously lying by way of concealing this information. Okay. I'm going to skip through this. Okay. Improper disclosure. Disclosures are supposed to prevent users of financial statements from being misled. So the purpose of a disclosure is, I want someone to get the full picture. And if I don't do it properly, I obviously know that the investor, whoever the potential investor, the user of the financial statement, is not going to have the full information. Therefore, they may make a wrong decision. So what are some of the improper disclosures? Liability omissions, subsequent events. What are subsequent events? Anything that happens after year end, before the financial statements are produced. If they are significant, they have to be disclosed. They don't affect your journal entries in most cases, but they have to be disclosed in the notes. If you do not disclose that information, it could have an impact. For instance, the best example would be if there was a lawsuit that you were engaged in, and on January 15th, you lost the lawsuit and there's going to be a settlement against you. That information is subsequent event. You need to disclose that information because we now know that you have lost the lawsuit and you're waiting to find out how much you need to cough up. By not giving that information, you're not alerting the user to the financial statement that there's going to be a big cash outflow out in the future without any corresponding cash inflow. Management fraud has to be discussed. Related party transactions, this is something you've seen in auditing. And why is it significant over here? Because if I do not disclose related party transactions, I'm basically covering up a conflict of interest. Remember what we've talked about in case of fraud. Conflict of interest is when there is something that I have where I could benefit in this transaction. It doesn't mean that I cannot engage in that transaction as long as that information is disclosed to all the relevant parties. And in the financial statements, it needs to be disclosed. So if those related party transactions are not disclosed, you're talking about conflict of interest, and it could also turn out to be self-dealing. And if there are any accounting changes, we already know this, they have to be disclosed because those could have an impact on your financial statements. Okay. Skipping through these. Improper asset valuation is the fifth type of fraud that a fraudster could perpetrate in a financial statement fraud. Here what we're looking at is, we know it's an asset, it's a matter of how we classify the asset. If we classify an asset as long-term when it is current, or current if it's long-term, we are messing with a lot of ratios, and we're also causing problems for financial statement users because they're making predictions about future cash flows based on how we have classified these assets. It could be vendor dressing. That is, I just want those ratios to look good. So what type of assets could be misclassified? Inventory, accounts receivable, business combinations, long-term assets. So we'll go over each of these. Inventory valuation. Inventory valuation, this typically is a problem if a company's sales have kind of slowed down and I have this backlog of inventory. I may have to adjust the value of the inventory down using the LCM principle. And there is a lot of room over there for companies to want to ignore that the LCM principle when the market is a lower number. Basically, they don't want to take any loss right now. They want to wait until the future. Manipulation of physical inventory counts. Obviously, if someone is stealing inventory, they want to manipulate the physical count. Inflating the unit cost used to price out inventory. Again, all of these are desperate measures. One of two reasons: someone is stealing inventory, or they are unable to sell inventory and they've said that they've sold that inventory. Failing to relieve inventory to cost of goods sold. Phantom inventory, that is making up inventory when it is not there. Okay, so again, we've talked about all of these issues with inventories in previous chapters, where the bottom line is someone is either stealing the inventory or they have cooked the books to say they've sold the inventory when they've actually not sold the inventory. Accounts receivable. They should be reported at net realizable value. Net realizable value is basically the gross receivables less the allowance for doubtful accounts. And companies may not want to do this for a variety of reasons. Not companies, fraudsters may not want to do this for a variety of reasons. One of them is if they have fictitious accounts receivable, if you have fictitious sales, you have fictitious accounts receivable. And this trying to play with these numbers is common at the end of the accounting period. False confirmations of balances to auditors. So I say I have these accounts receivable and I try to convince my auditors that these are the numbers. I do not write down the accounts receivable. And writing down again is basically those bad debt expenses. And why is that important? Because you're saying, based on knowledge I have right now, I know that I'm not going to collect this money and I need to take the loss right now. If I leave a receivable in my books, I'm indicating that there's going to be cash flow coming in the future, cash inflow. So I refuse to write down a receivable even when I know it's uncollectible. This was a problem in the banking industry when there was a housing crisis. When the market crashed, they had given loans to people who were unable to pay the loans. They had gone into foreclosure. The likelihood of the banks getting any money by selling those houses was not good because they had sold it they'd given loans for a much higher value than what the houses were worth now. There was every bit of information for them to write down those receivables, but they refused to write down the receivables. And the common explanation the banks had for why they did not do it is they had no idea what numbers to use, which is a little hard to imagine that such educated, talented people could not come up with an appropriate estimate. Business combinations. Here's another example. This is basically when that goodwill is created and when you have intangible assets. Tangible assets, it's a lot less likely that someone can manipulate those numbers because you actually have appraisers who will come and tell you what those numbers should be. Goodwill used to be a number that companies used to create and say, okay, I can amortize goodwill. Now there's been changes in the rules. Goodwill is not amortized. So that stays in your books over there. That doesn't mean that companies will not attempt to cook the books using business combinations. They over-allocate purchase price to in-process R&D assets. Again, what are they doing over there? Trying to capitalize all the in-process R&D. They try to establish reserves for various expenses to release in future dates. So there is still lots and lots of room, basically because you have to allocate the purchase price to tangible and intangible assets. Tangible assets, again, it's a lot harder to, not impossible, but it's a lot harder to justify some of those numbers. But intangible assets is very subjective in this process. Long-term assets, start with, like fictitious sales, booking fictitious assets, misrepresenting asset values, understating assets whenever possible. You either overstate or understate depending on how you want this to work to your advantage. Capitalizing non-asset costs, again, things that as in for instance, repairs and expenses, those should be expensed. If you capitalize it, you're moving it from the income statement to the balance sheet. Misclassifying assets, All of these, ultimately, someone has to take responsibility for what has happened, whether it was done by senior management, middle or lower level management. Someone has to be responsible for what happened for these financial statements. We know there are people outside relying on those financial statements, the information contained in the financial statements. So whose responsibility is it? It's ultimately the company management's responsibility. The board of directors and senior management have to set the organization's culture where you basically say that I will do the right thing, even if it means admitting we didn't perform as we had hoped we would perform. Things go bad, go south, even when you do everything right. It's the tone at the top that's going to determine how the rest of the company will react to situations where we don't perform as well as we expected or something actually went wrong. High integrity leads to more honest employees. So at the highest level, if you see the culture where you're going to say that this is the expectation is we will all come up with realistic goals, we will all work very hard to meet those realistic goals, and then take it from there. Unfortunately, that's not the case. To give you an example of a company that was very famous, and it was a CEO who was very famous for having these ridiculously unrealistic expectations, was Jack Welch. He was a CEO of GE. GE has had 12 divisions. This is a few years ago. And the CEO always told them that we are going to be number one in every single division, in every one of these units. So they had a credit card division, they have their aircraft engines division, they have their home appliance division. Everyone is told we have to be the industry leader. And what happens if you're not the industry leader? So this was some years ago. They had a credit card, and that division financial unit was not doing well. It wasn't doing as well as Jack Welch wanted them to do. And usually what happens is at the end of the year when they're making their promises for the next year, of course, everyone is going to say they're going to perform phenomenally well. It's like all of us start out by saying, yeah, I'm going to get an A in this class. So every manager is going to go there and say that they're going to do well, because if they say they're not going to do well, they're going to be out of a job immediately. So it's basically kicking the can down the road. And when the credit card division did not perform as well as Jack Welch had expected, based on the promises made by the senior management in that unit, they just decided to sell that unit altogether. Everyone in that unit was laid off. And we're talking about 20,000 employees. They were all just let go of. This was in Dayton, Ohio. The division was completely sold out to Capital One, and that was the end of it. The stone at the top, the pressure that was being created is really unrealistic. But Jack Welch says there's a reason why they are in the Fortune 500 list at the very top for years on end. Well, I guess that's one way to look at it. So remember the fraud triangle. We are looking at from the fraud triangle. I don't have my labels over here. The fraud triangle, we are looking at the pressure. When there is pressure, it is ridiculous what top management especially, it trickles down in terms of the pressure they will put on their people reporting to them. And all of this then creates this culture of creating this fraud, and it becomes something that people justify within the unit. They just think that is how it has to be because someone at the top is expecting it. That rationalization there is right there, saying that it's not me, it's someone else asking me to do it. Opportunity to do it, if you have a whole team working on this, yeah, there's going to be lots of opportunities. All you need to do is you need to fool the auditor. And if by some chance you can get the auditor to work with you on this, well, anyone who's relying on those financial statements, they're in for a big surprise, right? So from the fraudster's perspective, this was the guy, Crazy Eddie. If you looked at some of the things he has said, when he had his company, he started out in the electronics business. This was way back in the 60s and 70s. He actually had products that he was selling and doing well. He was a very good salesman. He was doing really well. Some of the things that started going downhill very rapidly were when he started stealing, as in, if he had, let's say, for instance, $10,000 in sales, he would report $5,000 in sales, and the other $5,000, he and his family members would steal that money. This just kept going. That was the start of how things started rolling in terms of what they were doing. They had all this cash. They were then financing the company from the stolen cash. It belonged to the company, but they had taken the money. They were selling it. They were investing the money in the business, lending it to the business. As the business kept growing, then they started creating fictitious sales. They just did everything you could possibly imagine. And then when the company became public, again, they continued. They invested their own money over there. All the stolen monies was invested in the company. The stocks went up. They sold all their shares. Again, this is stolen money that they put in. They took the money out. Just think about all the crazy things that you can do. Crazy Eddie did it. His philosophy was something like accounts payable. He gave a simple example of accounts payable. When you have accounts payable or accounts receivable, you can use a gross method or the net method, basically netting it against a discount. You have to disclose which method you're using and how it should be done. And back then, there were no rules about whether you should use a gross method or net method, what the disclosure should be, etc. And his philosophy was, I'll bury things in the footnotes. And the reason he was doing it was he was still coming out saying that, yeah, I did it right. I put it in the footnotes, keeping this at the back of his mind that even the most sophisticated investors were not looking at footnotes, which means those analysts, stockbrokers, they weren't looking at footnotes. He also recognized that auditors were under a lot of pressure. And when you have a company like his that was doing so well in terms of boosting their sales, their market was expanding, they had the IPO, they became public, all of those things. Auditors were just thrilled to get the business. And the audits were not planned very well. And some of the dirty games that he played was he would distract those auditors as much as possible. While they were supposed to be auditing his books, he used to take them out for long lunches, take them out to really fancy places, entertain them, and just keep them busy with doing anything but the audit. And when it came time to finishing the audit, the auditors were just signing off on everything. And he knew that he could play this game. And he played this year after year, pretty clever. He knew there were internal controls that were very weak within the company. And there was no one looking over his shoulder for any of this. And the auditors were very trusting for a variety of reasons. One is, who could actually point fingers and say this company that's doing so well that they're doing something wrong? I'm happy to have your business. And if I'm not doing my job correctly, as in I was just signing off on everything, I'm not going to come back and challenge you on anything. So fraudsters are pretty smart, especially when you're looking at financial statement frauds. They have thought through this process. It's not an easy thing to do, as I said earlier. So if someone is doing it, they've given it a lot of thought and they've seen how they can do this.